Good afternoon and welcome to the Lords Group Trading PLC full-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. Before we begin, we would like to submit the following poll, and if you give that your kind attention, I'm sure that would be most appreciated by the company. And I'd now like to hand over to Chris Day, CFO, and Shankar Patel, CEO from Lords Group Trading. Good afternoon.
Good afternoon, everyone, and welcome to our inaugural results as a listed business. The agenda today is that I will give you an overview of our results, followed by Chris doing the financial review. I'll then give you a strategy update and our progression on our ESG initiatives, which will be done by myself and Chris. And then we'll finish with a summary and outlook by myself, followed by a Q&A where we will welcome questions from the attendees. So on the first slide, if I can move to that, is a summary of our highlights. The four blocks that we've got in front of us, firstly capitalise on the fact that we've had a year of strong growth and good progress on our strategic initiatives. We have exceeded our market expectations. We have a strong momentum in our market. Our strategic initiatives are progressing well, and we also have very strong digital momentum in our business. In particular, to call out revenues of 363 million, on a like-for-like basis, 18.1% up versus 2020 and 20.8% up on 2019. A resulting increase in our adjusted EBITDA to 22.3 million, which is 40% on full year 20. And again, a flow through of the EPS at 5.48 pence, a substantial increase of 58.4%. But the growth will continue as we believe we have a strong market momentum. First of all, I'd like to say we are still a entrepreneurial, commercial and operational based business that is small in a very large addressable market, 55 billion, and we're less than 1% of that market. We're also buoyed by housing transactions, one of the key measures that we focus on to make sure that we understand will there be demand for our product and services. At present, housing transactions do remain buoyant, and so do property transactions, which brings me also to another area of our market which is growing, and that is the requirement to decarbonise the UK built environment, and we will be ensuring that we have our rightful place in this growing market. In terms of our strategy, we still maintain that we will reach 500 million revenue target within the 2024, which is well within our reach. Our acquisitions to date, of which we have done 7 between 2021 and 2022, allow us to increase our product and geographic extension. We now have multiple product brands and portfolio brands, that we can focus on expanding across the country. We're also focusing on ESG at the exec board level and using ESG to further commercially benefit our business as well as to meet our compliance and governance requirements. In the medium term, our target is to reach 7.5% EBITDA margin. On the digital side, we've had a great year with full year 21 digital revenue increasing by just under 30%. We now have 8 transactional websites. All of them are developed and managed in-house, something that we're very proud of so that we're not beholden to external developers and agencies. And we're also seeing an increasing buy-it-yourself trend, whereby homeowners or the eventual property owners are buying material on behalf of their contractor, largely led by price uncertainties or the fact that contractors may not want to cash flow the purchases of materials. This leads us very nicely in terms of our digital offering, and ultimately what our strategy on digital is that it is a great customer acquisition tool, but one that you use offline and online together, so that you give your customer the best experience in whichever way they want to trade. We're a business that believes that any which way you want to trade with us, online, offline, in store, by telephone, by email. You should get the best and consistent customer experience across all those channels. So in conclusion on this side, we believe that as far as we're concerned, the customer demand remains strong, and the board reinforces that its expectations are unchanged for full year 22.
Okay, good afternoon, everyone. I'll take you through the financial highlights and slides and talk through some of the numbers. So I think 2021 is a tremendous year for the group. It's a year in which we published record revenue of 363 million and record adjusted EBITDA of 22.3 million. Revenue grew by 26.3%, and most pleasingly, EBITDA outperformed that and grew by 40.1%. You see that flow through into the adjusted EBITDA margin of 6.1%, an improvement of 0.6% on FY20 and 1.2% on FY19. So really strong momentum there, which underpins our strategy, where all of the levers that we have around network optimization, product range extension, digital, and accretive acquisitions are coming through into the numbers. Profit before tax at 8 million and adjusted earnings per share at 5.48, a tremendous step forward in both of those numbers against FY20. And we're pleased to announce the full year dividend of 1.89 pence per share, which is perfectly aligned with the target that we set at IPO. At year end, net cash is 6.3 million. We'll talk later about how that's moved through following the acquisitions in Q1. And underpinning all of that is a really strong level of cash flow generation. So free cash flow of 87.4%. It's an area that we're very disciplined on, and so relatively consistent with the prior year, but both exceptional levels of cash flow generation. Moving to the two divisions. Merchanting a superb year. Revenue up 55.4%, which is fantastic. Like for like versus FY20, positive 27.6%, and on a 2-year basis, stripping out the impact of the pandemic, 20.4%. That's transferred down into adjusted EBITDA of 12 million, an increase of 76.5%, and driven the EBITDA margin up by 1.1% to 9.2%. Included in the FY21 numbers are the 3 transactions that we've made through the year: Matt Building and Civil Supplies, Condell, and Newline. Together, they contribute about 20 million of revenue into the FY21 numbers, and we'll get the full year effect into 2022. As I said, the growth there has really been driven by that passion for the customer, the focus on digital, and as we'll talk through later, the great opportunity that we have to extend product range and to continue to do that into the future. Plumbing and heating, I think great numbers, 232 million or 233 million of revenue, up 14% on a like-for-like and total basis, and 21% again stripping out the impact of the pandemic. Just EBITDA of 10.3, which is a record. But I think probably more importantly than the numbers it was year 2 of what we would deem to be a transformational project for APP, which is the bulk of the plumbing and heating division. It's a business we acquired in 2019, and through last year we managed to successfully implement the new ERP system. That's there to drive efficiency in our stock management, to drive better trading decisions around price and margin. And we're really pleased with how that's landed and the impact it's starting to have. We've also invested in capacity in the network, with 2 sites relocating through FY21, and we've strengthened the management team, particularly within the procurement function and the commercial function, which bringing in expertise from plumbing and heating competitors, which will allow us to pursue this extended product range, which the ERP also enables. So looking forward, 4.4% margin, we have strong hopes for that to step forward. We've spoke about a 1.5% progression as a group overall in the medium term, and we'd certainly be expecting plumbing and heating to pull its weight in that share with merchanting. In terms of free cash flow, as I said, really robust, 87.4%. I think probably two key lines to call out. One is the working capital. Our trade creditors are in excess of our trade debtors across the group, and we have sizable stocks in the core base of the business. Future stock holding is not linear with sales growth, and we expect to continue to drive that slightly positive inflow of working capital with growth on the current profile of business of the group. You move down to CapEx, 1.3 million. I think it's probably fair to say 0.4 million in FY20 is definitely not typical. 1.3 is probably slightly understated. Going forward, you'd expect that number to be running at kind of 2.5 on the enlarged group and the pipeline of opportunities that we've got, but always underpinned by that discipline of driving a 20% return on investment. I'll pass you back to Shane for the first couple of slides on the strategic update.
So we want to reinforce our investment proposition, and the IPO we set out some blocks on where we see our growth potential and our investment proposition potential. That's around organic growth or acquisitions, digital, and now also looking at our ESG strategy. In detail, in terms of our organic proposition, with the recent acquisitions, we have significant opportunity to broaden our product range. We have a suite of businesses covering from underground products all the way to the roof, and that allows us to cross-sell within our various divisions, either via implants or allowing divisions to trade with each other, ultimately for the benefit of our customer. So our customer offering, the products that we provide the customer, has increased tremendously. That drives further organic growth in our divisions and in our locations. But in addition to that, with multiple brands in our business now, some of them have great potential for expansion. In particular, George Lyons, our civils merchant, we opened a third branch in Horsham a few months ago. We see another 5 potential branch openings across the next few years, right across the country. Civils is a product area that we feel is underserved and has a lack of supply in key strategic geographical locations. We will be looking to expand this particular brand nationally. We also have Mr. Central Heating, currently only 9 branches. We see a potential for up to 50 or in excess of 50 in due course. We will be opening our 10th branch in the next few months. And so what we've got in the group is the ability to grow organically because of the geographic, product, and business diversity that exists amongst the brands that we have. But we also reinforce our acquisition proposition. We've been busy acquiring several businesses in 2022. Our pipeline remains active and strong. We still maintain our discipline of ensuring that we only pay between 4 to 6 maintainable EBITDA. And both our acquisitions and organic growth are anchored by our principles of investing in our 3 Ps. And that is investing in our people, our plant, and our premises. These are the key drivers of success in our business, whether it's organically investing in one of our existing premises or buying a business and then investing in its people, plant, and premises, either all 3 or only one, as the case may be. On our digital side, we're really pleased with the results that our in-house expertise is providing this accelerated growth. Our model is slightly different. We use digital not just for a one-time transaction, we use it as an exceptional customer acquisition tool. We believe the best way to serve a digital customer is just to take them through the journey of digital and then into the execution of delivery of their product. For that reason, we always invest in an offline customer service team that backs up our digital websites with phone calls, swallowing orders, to make sure that the customer feels confident that trading with us, they'll get a consistent customer experience, whether it's buying through the website, coming to our premises, calling us, or emailing us. The other aspect of our digital proposition is that it provides us with the data that we need, which allows our brands to expand, either in expanding products or in many cases expanding geography as we start to see where our customers are across the country and where there may be demand for further locations. On the ESG front, it's an early part of our strategy, but we are looking at making ESG decisions, embedded in our strategy, embedded in our business. A big element of that is that we feel that there are commercial opportunities by being focused on ESG, not just because we have some compliance or that we have to meet certain standards, but we think that by focusing on them, there are commercial benefits in efficiencies, waste reduction, and profit eventually. We will be formalizing our strategy during the course of 2022, and some of our current initiatives, such as Boiler Box, which is a boiler recycling scheme, the only one in the country, which was launched by us, or putting in technology that allows us to reduce idling time on our trucks, thereby not only saving us fuel, but also reducing our emissions. We're also looking at solar on all of our roof space, as well as making sure that our fleet is optimized towards hybrid or electric vehicles for all our colleagues. So there's many more aspects to ESG that we'll start to formulate during the course of 2022, but the strategic pillar is that we will use it commercially. In terms of our acquisition strategy, it's been a busy year. We've acquired 4 businesses. I'll start with the one on the left, AW Lum, which brought us into a specialist area of dry lining and insulation. Both are our growth product areas, insulation in particular, as we try to decarbonize and that product area is something that we've been keen to enter into for a number of years. The key management's been retained, which is a very, very big part of our strategy, is to work with the team that we acquire. And in this business, again, there exist opportunities to cross-sell amongst other parts of the group, to buy in conjunction with other parts of the group, but also geographical expansion. The business has 2 locations, one in Tamworth in the Midlands, the other one in Dewsbury in Yorkshire, and we see either the south of England, southwest or southeast as areas of expansion. The business does not have a digital presence, and again, utilizing our in-house team, we feel that there's tremendous growth for additional organic sales that we can bring to this business using our digital team. Similar story with HRP Trade. It's a distributor of plumbing spares alongside 5 plumbers merchants, and we feel that it's a great bolt-on for us. APP and Mr. Central Heating are some of the largest boiler suppliers and distributors in the country. Boiler spares is a natural extension to selling boilers. Once again, key management has been retained. We term this as relieving owners of the burden of ownership. And in both AW Lum and HRP, the ex-owners are now running the business under our ownership. And the initial signs are they're liberated from not having been shackled with the burden of ownership. And we provide them with the support so that they can focus on what they do best, which is serving our customers well and growing their business. Once again, there exists a digital opportunity in this business, as well as for Mr. Central Heating to expand its range of products. Similar story with Advance, a smaller business than the other 2, but it gives us product range expansion and a very good geographical fit in the Hertfordshire area. We will be putting in a advanced roofing implant in one of our Lords Builders Merchant sites. That will go live within the next 60 days. And it's a very exciting part of our business strategy where we take brands and implant them into other brands, thereby getting operational leverage from existing sites. Once again, key management has been retained. In this case, not the owners, but the team that were running the business. And integration thus far has been really, really good. And sales performance has also been very strong post-acquisition. And finally, we acquired the Sudbury branch, which was a divestment by Hughes Gray, who in turn were acquiring Grafton GB. Not only does this bring us into a new geography of Suffolk with close links to Cambridgeshire and Essex, but it was strategic because we wanted the market to know that if there are divestments, we are a good buyer. Certainty is what a lot of larger competitors need when they need to divest, and the manner in which we did this transaction signifies to the market that we're here to take a transaction all the way through to completion, and that we have the ability to acquire divestments if larger groups would need to do so. On the next slide, I think I'll hand over to Chris.
So this slide gives you a view of some of the hurdles that we've set ourselves and targets over the medium term. So 500 million on the left hand side is the target. Results today position is at 363. 500 was the target that we set at IPO by 2024, and we're very confident in delivering that. The transactions that Shank has just shown you on the previous slide take us to a pro forma run rate of circa 460 million of revenue and 29 million of EBITDA. So you can see that with 2.5 years to go, we're well on target to hit that 500 million number. On the right hand side is guidance for the first time around EBITDA margin, and we think we can add 1.5% to today's numbers and kind of sit in and around that 7.5%. And I think our strategy previously has been really clear around how we intend to improve margin, but the target on top is probably helpful for investors to understand the level of our ambition. As I said, we've improved margin by 1.2% in the last 2 financial years. We think we can add another 1.5%, and that will come through a variety of levers. Accretive acquisitions, fairly straightforward to understand. Optimizing the network. As Shank said, we've got brands that have regional presence that we think we can grow to a more national presence. The one that really stands out for me is Mr. Central Heating. It's a fantastic brand. It's in excess of 50 million in revenue, 35% online, out of 9 locations. That brand hasn't opened a new site for 10 years, and in the early part of H2 this year, we'll be opening the 10th branch in West Bromwich. Those branches deliver 10% EBITDA margin. They're low cost of capital to deploy, and they give a really nice high return on investment, which drives that free cash flow again. So that's a really good example. Branch 10 comes this year, but it's perfectly reasonable to expect that in the medium term there could be 50 of those across the UK. Digital is incremental for us. I guess not always profitable for everyone, but for us with an in-house digital team, in-house distribution, in-house delivery service, and the manner in which we're capturing those customers, as Shank has explained, we think that drives incremental profit and margin. Product range extension is another good one. You've heard the example with roofing and with heating spares. Another example in the APP wholesale business that sits within plumbing and heating. That is a low double-digit gross margin channel, but it has a real opportunity in radiators. Radiators is a very logical extension for a plumbing and heating distributor. The radiators operate at 35 to 40% gross margin, and so with that investment in the ERP system, we can deal with the complexity of extended product range. The investment in the commercial team, we can bring that product into the business competitively, and then we have the sales team to maximise the opportunity. And then underpinning all of that is operational leverage. I would say with the way the group structure is quite unique. We are divisional. We've got a really great set of strong divisional MDs, but they all have much greater bandwidth and capacity than their current divisions. So as we grow, we can yield operational leverage as well.
Okay, thank you, Chris.
And then I think this one just nicely articulates what both Shank and I have been saying around that return on investment and cash flow. Really disciplined at the beginning. We want a 20% return on every investment. But the areas that we'll look at is the organic. We spoke about the Central Heating opportunity. We'll take the bolt-ons, e.g. New Line, MAP, Sudbury on the couple of pages ago, or Direct Heating, but also attracted to the platforms where we can pick them up. APP is a really good example, as is AW Lum. All of that, if we're disciplined on the price we pay on the way in, which is always 4 to 6 times, always on a maintainable basis, with an eye on free cash flow conversion. So we will turn down a 4 to 6 times opportunity if its free cash flow conversion isn't strong or we don't think we can improve it. because all of that drives cash flow drives dividend and growth in the strategy, and the wheel goes round and round. And that's the rationale of our investment approach.
So I'll summarise with an outlook and how we see things moving forward. Underlying fundamentals of our market remain positive. Our customer demand thus far in FY22 has remained robust. We are pleased that our FY21 and 22 acquisitions are performing in line with expectation. As a business that is used to crisis and multiple ones in multiple years, we continue to manage the boiler supply issue, the inflationary issue on products, and supply chain pressures that we currently see. Our board remain confident in the ability to deliver our full year 22 market expectations. We talked about a market share growth via organic, digital, and acquisitive opportunities are plentiful, and we will continue to make sure we take those as they present themselves. Ultimately, we reaffirm our strategy, which is that we are well positioned to deliver 500 million group revenue by 2024, whilst growing our margin to 7.5% in the medium term. I'll conclude with a statement that as a business, we stride ourselves on doing what we said we were going to do. We believe that our results for full year 2021 delivered on what we said we would at the time of our listing. Thank you very much.
That's great, Shanker. Chris, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. While Shanker and Chris take a few moments to review those questions submitted already today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we'll email you when that's ready for your review. Shanker, Chris, I haven't given you any time at all really to look at the questions that have come in from investors, but if I could hand back to you just to read out those questions and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Sure, fine. Right, first question from Paul S. It says acquisitions 7 in 2021 and 4 more in 2022. Is this too fast? How can you manage such a rapid pace of acquisition? So it's actually 7 over that whole period. So 3 in 2021, 4 in 2022. But I think the question is still relevant, and Shanker will answer it.
Yeah. So the real way of managing is that, number one, all these acquisitions sit in particular divisions. So if you look at Sudbury sits in a business called Heavy Building Supplies. The acquisition of Direct Heating sits in APP. These divisional teams have the bandwidth to grow and to consume acquisitions. What we also do with each acquisition is we plan out the integration process well in advance, and we know exactly how to integrate our business. Quite often, the integration process starts with minimal change initially, as we embed the business and get them to understand the culture, the values, the expectations of our group. And we always go in with what we call a collaborative approach. We don't buy a business to strip it apart. If there is a broken business, we understand that that's what we've got to do. We buy and large businesses that can do with some change of ownership and therefore incremental investment and support. What we provide them is that incremental investment and support, and that the teams grow their business, that the teams deliver on what we need them to do. And thereby the resource it takes from the centre to manage acquisitions is mainly around the transaction, not the post-transaction. If I take AW Lumb, it's a standalone business. Our involvement was to deliver the acquisition. Post-acquisition comes the more synergistic element of Lumbs talking to either Heavy or Lords Builders Merchants and developing that supply chain conversation of where they can all benefit. But essentially, the business is still running as it did with zero change in its day-to-day operations. That allows me and Chris to then set them a strategic brief on what we would expect them to deliver. And by and large, it will be investment-led. Where are the resources that you didn't have previously, or the focus that you didn't have previously? So it's a very light touch requirement post-acquisition. but front-loaded in actually getting the transactions over the line. Again, we have an acquisitions director, we have a good team, and good experience of acquiring businesses. To date, we've acquired almost 15 businesses in the last 10 odd years and successfully integrated them. So we're very confident that actually our ability to make multiple acquisitions and to implement a good synergistic as well as integration strategy is not an issue or barrier.
Okay. Next one from Paul S. Results are very late. Shareholders were not told about trading until late April's trading update. Do you recognise this, and how will you speed up reporting, please? So, Paul, I think year one after the IPO, a huge amount of work goes into preparing those year one numbers. Yes, absolutely, you'd expect the pace to pick up, albeit it needs to be at a pace that we can achieve. Some of our peers in the industry that listed last year have missed their deadlines. So I think it's about. I think for us, we like to be very clear on our targets and provide regular updates. But it needs to be at a pace the business can work to. Another question from Paul S. Shortage of boilers. Can you jack up prices given tight supply? Is this a profit opportunity?
There is an element of profit opportunity, but we are a customer-focused, long-term, sustainable business. What we want to do is make sure that that we get good value for the products and services that we provide to our customers. Profiteering out of a external circumstance isn't part of the value of the group, but being efficient and dealing with the crisis and making sure that we don't lose from such external events is something that definitely we will be doing, and we have been, and therefore we thought it was prudent to inform the market of the supply shortages, but also to reinforce that we are confident of meeting our full year 22 expectations.
Okay, next one is from Matthew R. What lessons have you learned from the 7 acquisitions? How competitive is the bidding process normally, and what's the reason behind your success in winning?
Really good question, Matthew.
Go back to the
So the operative word in your question is process. Where there is a business that is sold through a process, we will not participate in that process. When you have a process-driven sale, it is a bidding process, effectively. There is no collaboration between buyer and seller. There isn't a cultural alignment that you can envisage, and you're really buying a business based on the vendor expecting really just one thing, and that is the highest price. We stay away from those kind of vendors. What we like is a collaborative process, one where generally we are approached. Now, if you look at all 4 of these acquisitions, we were approached by all 4 of the vendors. In AW Lung, there were 6 owners, 3 of them were retiring, 3 wanted to continue. The managing director of the business of 73 approached me through a person that we knew in the industry. We met for lunch, which is a big part of why we succeed, because generally, if you want to sell your business to us, you've got to have lunch with me. The reason for that lunch is it's over lunch that we really find out the culture of the business, what's created the success of this business, what, apart from price, is of importance to the vendor. We did that at Lum's. With HRP, it was a similar situation. The vendor had met myself and Chris, and it was at that meeting we understood the requirements of the vendor. He understood how much we were willing to pay, and from there onwards it became a collaborative process to make sure that the transaction could be executed in advance. We were a customer of Advanced Roofing Supplies. The 2 owners post-pandemic wanted to get out. And again, there was no other bidder, even though they had letters from private equity and other competitors offering to engage with them in buying their business. They were already in an exclusive arrangement with us by the time that the market realised we were buying this business. And what can I say about Sudbury? I got a phone call from the CEO of Hughes Gray to say I might have an opportunity as a result of his acquisition of Grafton, and his words were, "We need to find a good buyer." And I think that's ultimately why we're successful. The market knows we are good buyers. We make the process. And in the case of Advance, when I concluded the transaction, the two owners turned around and said to me that we thank you for making one of the most difficult decisions of our life look so easy. Because that's what we do. We make the process for the vendors, easier than anybody else. We hold their hand through things like financial due diligence, legal due diligence, all of which is a big requirement and frighten vendors usually. But we have a collaborative approach whereby we make sure that they focus on the fact that the end game is they want a transaction. That approach, which now the market realizes is very different to a process-led approach, is why we're successful in getting exclusivity on many of our acquisitions.
Okay, next question is from Mark A. Good progress, congratulations. How fragmented is the market and where is management's focus in the near term, organic or M&A?
I'll let you take that.
Go on, answer that. So I think the answer, Mark, the market is very fragmented. So we're less than 1% of the market today. 40% of the market are independent merchants, and we talk about them having a set of common traits. So an aging demographic of ownership, they've not invested in their business, and they lack succession within family or what are often small management teams. So that's a really kind of large, substantial pipeline nationwide of potential acquisition opportunities. In terms of focus, it remains both. We've explained a huge number of organic opportunities that we have around growing the network through some of the brands that we've called out, but there are also more. Mr. Central Heating, George Lines, Condell, they're all capable of growing. We've spoken about product range extension, and that exists in plumbing and heating and in merchanting. We've got the opportunities on this page around all these acquisitions and making sure that we maximise the full benefit of everything we've acquired, because there's extensive opportunities in all of these transactions, particularly AW Lum, direct heating, HRP trade, and advanced roofing. They offer real opportunity to drive synergy and upside. And then from an acquisition perspective, as Shank said, we don't chase the process. So the vendors come to us, but there's always regular dialogue ongoing. I think we felt it was right to take a month or two's breather, but you've got to then wait for the right opportunity. We don't want to set ourselves a target that we have to chase. Chasing acquisition targets will create bad decisions, I think. And we also just need to balance the leverage. We've set ourselves a target of circa 1.5 times. That's not a hard number. We would go higher for a good opportunity, provided we can come down again quickly enough. But the answer in a nutshell is both, and lots of opportunity in both. And I think the final question is from Matthew R. To achieve your target to be a 500 million turnover business, how do you see the split being between digital and physical?
So that's a really interesting question. So for us, digital and physical are actually intertwined, and the reason why that's the case is because if you concentrate purely on digital sales, they tend to be one-time transactions. And our business is actually designed to have customers over a substantial life cycle, substantial length of time. And the digital customer starts as a one-time transaction in most companies, but in our company, we turn them into regular customers. So that the idea is that it's possible for us to market and bring people onto our websites. That's a great strategy. We're investing a lot in that. But actually, the way to really profit from that cost of acquisition is to make sure they come again and again. And to be able to do that, we believe that we have to give them a far greater proposition than just a fantastic digital offering. We have to give them a fantastic in-store offering, a fantastic offering on telesales, a fantastic offering in us visiting them if that's what they require. So when you put the two together, the split is that through digital means you acquire customers, and we can get that up to 25%, which is our stated aim. But ultimately, the real aim is that all of our customers have the ability to transact with us whichever way they want to transact with us. Not all customers want to buy all the time through digital means. They do need to come and see us. If there is a product specification that is complicated, you cannot do that through your website. You have to either call or sit with one of our colleagues and go through that particular requirement so that you get it right. So therefore, we believe in providing great in-store service. Quite often they need account management. And again, that requires somebody at the end of the phone to be able to serve that requirement really well. And quite often they just want to send you an order, but without calling into you, by just email. So we see all of these pieces have been digitally connected, and digitalization is a big part of our process improvement so that we can give the customer the best experience. This is why we've invested in delivery tracking service. Still one of the only builders merchants that provides delivery tracking service. And when you go onto our website, especially at Lord's Builders Merchant, you'll see a raft of reviews saying that people really appreciated. They got to know when our deliveries were arriving. And that's because in merchanting, generally people don't. Suppliers don't have that capability. And that's a digital capability for us, which leads to greater sales. That customer might have called into our depot or might have called us. But they're going to get a digital service on DTS. And there are a raft of initiatives such as that we're planning, so that our overall sales increase. And we don't have to necessarily define it in strict terms that digital has X amount of turnover. It's how digital and physical are connected together to grow our business and give our customer the best experience.
That's great, Shanker, Chris. I think you've taken all the questions from investors. So thank you once again to everybody that submitted questions during today's presentation. Shanker, Chris, I know investor feedback is important to you guys, and I'll shortly redirect investors to provide you with their thoughts and expectations. But I guess before doing so, I wondered if I may, Shanker, just ask you for a few closing comments just to wrap up with, and then, as I say, I'll redirect investors to provide you with their feedback.
Okay. Well, we're delighted again, at our full year 21 performance. We thank all our colleagues who've helped to deliver this performance, and we reinstate that we, as a business, believe in doing what we say we're going to do. We are confident of meeting our strategic aim of delivering 500 million revenue group by 2024.
That's great. Chris, Shanker, once again, thank you very much indeed for your presentation. Could I please ask investors not to close this session, as we'll now automatically redirect you to provide your feedback in order the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Lords Group Trading PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and may I wish you all a very pleasant afternoon.